Why does losing $100 hurt more than finding 100 feels good? Hey everyone, welcome back to the channel. Today, I want to talk about something that affects every single one of us, whether you're a seasoned investor or just starting to dip your toes into the market. It's about the psychology of losing money, especially in the context of the 2026 crash that's been all over the news this week. You might have seen the headlines: markets tumbling, portfolios shrinking, and panic everywhere. But here's the thing, the real enemy isn't the market itself, it's your own brain. We're wired to feel the pain of losses twice as intensely as the pleasure of gains. This is called loss aversion, and it can lead us to make terrible decisions, like selling at the bottom or holding on to losers for too long. In this video, we'll dive deep into why your brain hates losing money, how this has played out in the 2026 crash, and most importantly, what you can do to protect yourself from your own mind. So, if you're ready to understand the psychological traps that can ruin your financial future, keep watching. Let me paint a picture. It's a typical Tuesday morning in 2026. You wake up, check your phone, and see that your portfolio is down 10%. Your stomach drops. You feel a knot in your chest. You immediately think, I need to sell before it gets worse. This is a classic reaction, and it's driven by fear. The problem is, this fear is not rational. It's your brain's way of protecting you from a perceived threat, but in the financial world, it can be disastrous. The 2026 crash has been particularly brutal. We've seen major indices plummet, and many investors have been caught off guard. The fear of losing more money can be paralyzing, leading to panic selling, which only locks in losses. But it's not just about panic selling. There's also the opposite side, the sunk cost fallacy. You hold on to a losing investment because you can't bear to admit you made a mistake. You think, I'll wait until it recovers, then I'll sell. But that recovery might never come, and you end up losing even more. These two behaviors are rooted in the same psychological mechanism, loss aversion. We hate losing so much that we're willing to take irrational risks to avoid it, or we freeze and do nothing. In this segment, we'll explore why your brain is wired this way and how it's been amplified by the 2026 crash. So, why does your brain hate losing money so much? It all goes back to evolution. Thousands of years ago, our ancestors lived in a world where resources were scarce. Losing food or shelter could mean death. So, our brains developed a strong negative response to losses to keep us alive. This is known as the negativity bias, and it's still hardwired into us today. In the modern financial world, this manifests as loss aversion. Studies by psychologists Daniel Kahneman and Amos Tversky in the 1970s showed that people feel the pain of a loss about twice as intensely as the pleasure of an equivalent gain. For example, losing $100 feels worse than the joy of finding $100. This asymmetry in our emotional response leads to irrational behavior in the stock market. Let's look at how this has played out in the 2026 crash. This week, the market saw a sharp decline, and many investors reacted in predictable ways. Some sold in a panic, driven by fear, while others held on, hoping for a recovery, driven by hope. Both are emotional responses that ignore rational analysis. Another cognitive bias that comes into play is the herd mentality. When everyone around you is selling, it's hard not to follow the crowd. Your brain tells you, if everyone is doing it, it must be right. But usually, the crowd is wrong at the extremes. The 2026 crash has been characterized by a lot of fear and uncertainty, and the media has amplified it. Every day, headlines scream about the worst-case scenarios, feeding our anxiety. It's a vicious cycle: fear leads to selling, selling leads to more fear, and the market spirals. But here's the thing, if you can understand these psychological traps, you can start to overcome them. In the next segment, I'll share some strategies that have helped me stay rational during turbulent times. So, how do you protect yourself from your own brain? The first step is awareness. Simply knowing about loss aversion and other biases can help you recognize when they're influencing your decisions. When you feel that urge to sell in a panic, pause and ask yourself, is this based on facts, or is it just fear? The second strategy is to have a plan before the market crashes. If you've already decided in advance what you'll do in different scenarios, you're less likely to act impulsively. For example, you might decide to rebalance your portfolio once a year, regardless of market conditions. This forces you to buy low and sell high automatically. Another powerful technique is to focus on the long term. Remember that market crashes are temporary. Historically, the market has always recovered over time. If you have a diversified portfolio and a long investment horizon, you can ride out the storm. The 2026 crash is a test of your discipline. Instead of checking your portfolio every day, set a schedule maybe once a month. This reduces the emotional impact of daily fluctuations. Also, consider talking to a financial advisor. They can provide an objective perspective and help you avoid making impulsive decisions. Finally, practice mindfulness and emotional regulation. Techniques like deep breathing or meditation can help you stay calm during market turmoil. By mastering your emotions, you can make rational decisions that align with your long-term goals. Remember, the goal is not to avoid losses entirely, that's impossible, but to manage your reaction to them. To wrap it up, the 2026 crash has been a stark reminder of how our brains are wired to hate losing money. We've seen panic selling, herd mentality, and the sunk cost fallacy all in action. But by understanding these psychological traps, you can take steps to overcome them. The key takeaway is that investing is as much about psychology as it is about numbers. Your biggest enemy is often yourself. So, what can you do? Start by acknowledging your biases. Create a plan and stick to it. Focus on the long term, and don't let short-term volatility dictate your decisions. And remember, you're not alone. Many investors are going through the same emotions right now. If you found this video helpful, please give it a thumbs up and subscribe for more content on investing psychology and financial wisdom. Also, let me know in the comments, how have you been handling the 2026 crash? Have you been tempted to sell? I'd love to hear your stories. And if you want to learn more about specific strategies, check out the links in the description. Thanks for watching, and I'll see you in the next one. Stay rational, and don't let your brain bet you.